Hey guys, this is Benjamin from benjaminhedge.com. Please hit like and subscribe as I will try to make more of these useful market related, investing related videos for all of you. One of the first things I think that's truly important in terms of becoming a better investor. So if you're lazy and you want to just be a market return investor, just put your money in a passive S&P 500 index, which is a great choice. But if you want to beat the market or try to do a little better than the market over time, it's actually not that difficult. You just need to learn a few basic steps that could dramatically improve your game. One of the first things you should do, which is what all professional investors do, is make sure you buy and sell over time. Now, this might sound like very simple, very straightforward. You've definitely heard of it. You've probably heard of dollar cost averaging. You've heard of buying over time, but most people do not pay close enough attention to it. Most people think, oh, that's just a way of reducing your risk, but there's also a chance of missing a lot of the upside if you don't deploy your capital, if you don't get the capital to start working for you immediately. But almost all professional investors do. If you don't, that usually results in much worse performance, especially in the long run. Why is that? Let's dig in. One of the first reasons is human psychology, because it feels so. Human psychology is very simple. The herd mentality. If the market is going up or if a stock is going up, it's a natural human tendency to try to buy more. And same is true for when the market is going down or a stock is going down. So as it comes down, if you want to reduce your risk, which is a natural human tendency because we hate losses, if you do that, which is fine too, but do it over time. So even if you have a smaller account, say you have a $10,000 position, try to split it up into at least five increments. So if you have a $10,000 position, either you build the position over time or you reduce your position over time. You always want to do it in increments, even if it's over a 2-week period. So say you have $10,000, there's 10 trading days. Just take 10% of that 10,000, which is $1,000 every day, or every other day, take down 20%. Second, number two, why it's really important is because of overall exposure. What does that mean? Because if you move your position incrementally over time, it's much easier to control your overall portfolio's exposure. For example, if you have crypto related stocks over the last 3 months, it's been painful. I understand, and I agree. But instead of when it comes down and you just dump that entire 20,000, what you should be doing is that as the market or as crypto stocks come down, you sell them to reduce your exposure further. Now, say you started with 20,000, the stocks are down, say 20%. So you have 16,000 left. Now sell 10% of that and take it down to, from 16,000 to say 14,000, and then wait another few weeks, take it down further to 12,000 to 10,000. Now, which is sometimes unfortunate, but if you take that position down all the way to say $8,000 or $6,000, all of a sudden, even though some of it were lost, all of a sudden you look at your $100,000 portfolio and you say, okay, the $6,000 exposure instead of $20,000 exposure now is a very small part of your overall portfolio's exposure. It's only 6%, or maybe you've lost some money, so it's like 8%, right? Now it's a much smaller part of your overall portfolio exposure that you are able to stomach that fluctuation. And if you're still bullish on crypto in the long run, maybe you are more able to hold on to it. So it's not as painful, even if it keeps going down, because now it's only 6% of your overall portfolio. And vice versa is the same. If you get into the habit of building your portfolio, building your position over time, then all of a sudden it becomes a much easier decision on a day-to-day basis. Now, on the flip side is also true. Say you started accumulating those memory stocks, say SanDisk or Western Digital, those stocks that we talked about about 4 or 5 months ago to start building. We started buying them when they were like $100. Now it's 300, 400. Now, when we started accumulating, we were not 100% sure. Nobody is ever 100% sure of a position. So when we started accumulating, we put 2%, 3% of the portfolio into these accumulation stocks, right? So if you're wrong, then not a big issue. If you're right, something interesting happens is that say at one point we wanted it to become 10% of our portfolio, those storage stocks, right? Now, when we first bought it, when we spent 2-3% of our portfolio buying those, and the target is 10%. Now, as the stock grows very quickly, this original 3% becomes 6%. Now, our target is only 10%. So all we needed to do is add another 4% over time. And now I'm simplifying the process, but that's the idea, is that as you get into the habit of selling over time and buying over time, every single small decision becomes much easier when you're actually executing, because all of a sudden you realize that every small step is working for you instead of against you. Because when when you just started buying at 2-3%, if the stock all of a sudden drops, and if your thesis is still intact, then you'll be very happy. You are accumulating at a lower cost. Now, if it already started skyrocketing before you could catch up, yes, you made less money. That's fine. But it's much easier for you to control your overall exposure, so you never get extended. You never end up sitting on like 40% of your portfolio in one stock, which then becomes a highly volatile portfolio. Okay, so this is a quick, simple first lesson on how to become a better investor. So first thing first, very easily done. Just get into a habit of buying over time and selling over time, and you will see that it becomes a much easier, much less stressful process in terms of investing in stocks. Okay, please hit like and subscribe, and we'll be back very soon.